Welcome to Business Exit Success, the podcast dedicated to helping small business owners on how they can successfully transition out of their business on their terms while also living a life of purpose and fulfillment after the sale. I am your host, certified financial planner and certified exit planning advisor, Tom Poltersdorf. All right, today we are continuing our discussion on retirement plans and ways to save, invest, and build wealth outside of our business. Remember, for many owners out there, it is highly likely 80% of your wealth is your business. So the past two episodes, I've discussed different retirement plan options like the 401k and the SEP IRA. The Roth IRA is something you can do in addition to those plans if you wanted to. You can put up to $6,500 into a Roth IRA per year, and if you're over the age of 50, you can add an additional $1,000 as a catch-up contribution. Now, to contribute and do this catch-up contribution, your modified adjusted gross income has to be under the phase-out limits. I will get into those a little bit later in this episode. Now, I realize too, with the Roth, you cannot put in nearly as much on an annual basis compared to the 401k or the SEP. However, for business owners who are making $400,000 a year, you're maxing out your SEP or 401k, using the Roth as an additional savings vehicle could be a good strategy for you. So first, one of the biggest differences I want to mention right away and make sure everyone understands before we dive into the benefits of the Roth IRA is that when you put money into a Roth, it is with after-tax dollars, meaning you're paying taxes on that money when it goes into the Roth IRA. There is no upfront tax deduction, but when you take money out down the road, it is all tax-free. I will come back to this point shortly, so let's start diving into the benefits. Okay, so number one, you get tax-free growth on the money you invest, so you don't have to worry about reporting any earnings that you made on your money. This includes any interest or dividends that you may receive within the Roth IRA, depending on what investments you own. Second, you can take tax-free withdrawals in retirement if you meet certain rules. So if you're age 59 and a half or older and you have owned your Roth IRA for at least 5 years, you can withdraw your contributions and earnings from your Roth IRA without paying any penalties or taxes. Now, one thing I want to mention and clarify in regards to the second part of this rule, which is owning the Roth IRA for 5 years. I receive a lot of questions on when does the clock actually start to satisfy the 5 years. It does not start if you just open your Roth IRA. You need to open the Roth IRA and fund it. The 5-year period starts on the first day of the tax year for which you made a contribution to your Roth IRA. This includes if you started funding your Roth IRA with a prior year contribution. So as an example, if you contribute to a Roth IRA for the first time in early 2023, before the tax deadline of April 18th, and you make the contribution for 2022 tax year, then the 5 years will end on January 1st, 2027. 5 years after January 1st, 2022. So if you are over the age of 59 and a half, don't just assume all of your earnings is tax-free in the Roth IRA. Make sure you also qualify for the 5-year holding period. The next awesome benefit with a Roth is there is no required minimum distribution. There is an IRS rule that states when you turn age 73, you must take money out of your traditional IRA, SEP IRA, simple IRA, and retirement plan accounts. If you don't take that money out, there is a 50% penalty. This does not exist with Roth IRAs. Another benefit for those who make too much money and are above the income limits for the Roth IRA, you may be eligible for what's called a backdoor Roth IRA conversion. There is a phase out to contribute to the Roth, meaning if you file single for tax purposes and your income is more than $153,000, you don't qualify to contribute to a Roth IRA. Or if you file married filing jointly and your income is above $228,000, again, these numbers are for 2023, you don't qualify as well because you're over the phase out limit. The backdoor Roth is a simple way to get around that. You would make a non-tax deductible contribution to a traditional IRA, which has no income phase-out limits. Then you'd move that money from the traditional IRA into a Roth IRA using a conversion. Now, yes, this is a legal strategy. The IRS is aware of it, so you can totally do this. I would recommend, though, getting tax advice first because this will be a taxable event. And honestly, it can get messy if you also have existing traditional IRAs. So please, this is not a recommendation to do it on your own. Reach out, get some help, do it right. But it can definitely be done for those folks who are over those phase-out limits. The next benefit, the beneficiaries of your Roth IRA won't be taxed. So if you own a Roth and you pass away, the beneficiaries listed on your account will most likely have to open a Roth beneficiary IRA account in their name. And they receive their percentage of your account at whatever amount you had them listed as. As of right now, for 2023, the Roth IRA beneficiaries will have to take required minimum distributions on an annual basis, but they won't have to pay any federal income tax on their withdrawals, as long as you had your Roth IRA in existence for 5 years. Now, what will be changing starting in 2024, this is new, inherited Roth IRA accounts will no longer be required to take any required minimum distributions. Again, so this is for people that inherit your Roth IRA. They won't be required to take anything. So the Roth gets even more attractive, not only for yourself while you're living, but as an account to be part of your estate plan and pass down assets to your kids and family. They can inherit your Roth IRA, not be forced to take any money out, and use it for whatever they want, completely tax-free. That's a pretty good deal if leaving a legacy is important to you. The last benefit I will mention is the flexibility a Roth IRA can provide if you needed access to your contributions. So any money you put into the Roth IRA, your total contribution amount, you can take out penalty-free and tax-free whenever you want. As an example, if you've had a Roth IRA for 3 years and its value is $30,000, let's say of that $30,000, $20,000 are your contributions that you've made into the account. And the remaining $10,000 is the earnings and growth you've made over the 3 years. At any time, you have access to take out the $20,000 penalty-free and tax-free. If you took out more than the $20,000, you are now dipping into the earnings, which could be subject to a penalty and taxes if you're under 59.5 and you haven't had the Roth IRA for at least 5 years. So, in summary, the Roth IRA can be a fantastic savings vehicle in addition to contributing to a 401k or SEP IRA. You just need to have earned income in order to make a contribution to the Roth IRA. I will include resources in the show notes for those who'd like to look into the details, and I appreciate you all listening and make it a great day. Hey everybody, real quick before you take off, if you found this episode helpful in any way, please rate the podcast and leave a review. I would love to get your feedback and see if there are any topics you'd like to hear more about going forward. Thank you, and I appreciate you all very much.